This tip I'm about to show you will drastically reduce the rate at which your stop loss gets hit as a supply and demand trader. Let's get into it. So looking at this 15 minutes time frame chart on gold here, the first thing you want to do is, okay, this is too close. Let's look at it from a bigger picture, right? If you're looking at it from a bigger picture, because that's how you want to trade, you can see there was an uptrend on Thursday, March 25th 2025. There was an upward trend until we got to this very point whereby there was a last buy before a sell candle that broke structure, so which means this was a supply zone here created. All right, so now we want to zoom this in like this so we can get a clearer picture and then mark our analysis to trade off from it. Okay, let's make this bigger like this, maybe too big. Perfect. So the first thing you want to do as a supply and demand trader is mark out your zones, right? That is how you will have taken the trade, or that is how you'll have made your analysis. So the first thing here is we can see a supply region formed from this candlestick to this candlestick right here. So we had this supply region formed here like this that broke structure. All right, so I'm assuming everybody is going to make their trades this way, which is very, very normal. This is how I'll also make my analysis. But why I'm making this video is because your stop loss will get hit, and then I want to explain why your stop loss will get hit at this trade and how you could have avoided it. So stay tuned as I keep explaining. So you want to mark this as your supply region or your supply POI like this here. This is your supply POI. Okay, it's broke structure, which is very, very clean. There was a strong sell downwards, and then at this point we had the liquidity, because at this point price refused to go down below this point. So this was the last point in which price rejected from. So I'm going to name this liquidity here. All right, cool. So now we have our key points marked. We have the supply region or the supply point of interest, and then we have the liquidity in which price respected and then rejected. We could see a bullish change of character on the 15 minutes time frame, signifying that okay, the market is going back into an upward trend. So it means the downward trend is over. All right, so that's not the whole story about this video right here. The point is, how does your stop loss get hit? What happened? How would you have taken this trade? How would I have taken this trade? And what will have been the outcome? Now, we have two types of traders. We have the trader who doesn't wait for price to get to his point of interest before setting his limit order down, believing, okay, price is supposed to respect this my point of interest. So I'm just going to set a limit order down and see how price reacts when price comes there. Or it just triggers me. If it hits my stop loss, fine. If it hits my TP, good. That is not a bad way to trade. That's a very good way to trade. I used to trade like that way, but I do not trade like that anymore. And then we have the trader B, who uses smart money concepts in conjunction with his supply and demand way of trading, which means you want to see how price reacts first when it gets to your point of interest before you can decide if you're going to take that trade or not, or you're going to find an entry and then, you know, take the trade or not. So regardless of both, I'm going to be doing the analysis on the two traders, which means if you fall in the category of those who set their limit orders down, and if you fall in the category of those who wait for price to react at their point of interest, this video will still be of use and value to you. So let's continue. Now, trader A sets his limit. This is how trader A is going to set his limit. He's going to set his limit like this. You want to take a shot, obviously. So we have the stop loss is going to be slightly above this region like this, and then entry is going to be at the last buy candle before the huge downward push. And then we have for targeting a 1:2 risk to reward ratio at the minimum. We do not trade 1:1 here. We trade at least 1:2. If you've been following my previous videos, you will see that I preach against 1:1 risk to reward ratio, because it doesn't just make any sense, right? You want to be taking at least 2 steps forwards and then 1 step backward in whatever you are doing. You don't just want to make money today, lose money tomorrow, because you cannot always be correct when trading. All right, losses will come, but if you are making more than you lose, then that's really the way you can manage, you know, and still come out profitable at the end of the week, at the end of the month, at the end of the year, or whatever. So now this is trader A analysis, right? Trader A. So congratulations, trader A will have gotten his TP hit on this particular trade, right? Because this is the supply region. You set the entry, you set your stop loss, targeting a 1 to 2. Good. So trader A wouldn't have had any issue on this trade because he set his limit order down without waiting for price to tap in and see how it reacts. That's it. Now let's move on to trader B, who trades using smart money concepts, in conjunction with the supply and demand, like the way I do, and some of you watching this video do. Right? So now you want to see this. This is what happened. Price came here, grabbed this liquidity, and then started pushing up backwards, never went back to this place, which means this was a freshly created area of demand. The last sell candle before the buy upwards. This was a freshly created area of demand, like this. So I'm going to change the color and name this demand area. Demand area. All right, perfect. That's it. We have the demand area. So price, I think price still came back to tap there, respected it. It came back, tapped there, respected it, went up, tap it again. Okay, it didn't tap it the second time, but it was close, and then kept going up. So now this is the moment we've been waiting for as a smart money concept trader. How did price react? So you can see price came to your supply region very well and good, tapped it, and then we had a doji candle, tapped it, and then respected it and went downward. So which means that supply zone was very, very strong to trade off with. But as a smart money concept traders, we don't just enter like this. You want to look for a change of character, right? You want to look for a change of character that can help you take that trade or find an entry. So now we come down to the 3 minutes time frame here. On the 3 minutes time frame, let's refresh this. Good. On the 3 minutes time frame, it was on Monday. Yeah, let's go back in time to Monday. Back in time to Monday, back in time to Monday, back in time to Monday. Ooh, a bit far. All right, here we are. So let's see how price reacted at this very point. Here we are. This is on Monday. Very good, very good, very good. So I'm going to zoom this in so you see clearly with me. Now look at this, on the 3 minutes time frame. Remember, this is the 15 minutes time frame here. Price tapped in, respected it, and went down. So we can see here price also tapped in and then formed a change of character and then went down. So now this is how you're going to set your entries. There's nothing you want to tell me. This is how you're going to set your entries. There are either two ways you set your entries. Some people, so now you want to set your stop loss like this, which is a very, very bad thing to do, and I'm going to explain why. You set your entry at the change of character line like this, targeting a 1 to 2 risk to reward ratio. Or you trade like me, who likes to look for the freshly created supply area, which is this last buy candle before the huge downward candles. So we have an entry like this, stop loss at this highest point here, and we are targeting a 1 to 2 risk to reward ratio at the very minimum. So let's see how this trade played out. So now you can see the trade came like this, because obviously you cannot just enter at this point. You want to set your limits order down and wait for price to come back, tap you in, and then you have that push downward, right? So what happened here? You'll have got tapped in quite all right. You got tapped in, right? And then price came back in profit, started ranging, for a very long period of time, which I hate. I hate when price ranges for a very long period of time, and eventually your stop loss would have got hitting on this trade, despite the fact that this supply region was actually valid to trade off from. Now, what went wrong? The issue is whenever you're trying to trade, you know, supply and demand, you want to make sure that there is a fractal high at, you know, behind your change of character. If you haven't watched my previous video, just watch this video and then watch the previous video where I explain how to trade gold using supply and demand strategy. You will see there needs to be this kind of, let me draw it using a trend line. There needs to be this kind of sweep, something like this. Let's make it black. So there needs to be this kind of sweep. So we have this strong push into, you know, that supply region, a very strong push into the supply region, and then it wicks out. It wicks out, signifying that this point was very strong. So we have a strong candle which was bullish, but then when it got to that region, it wicks out of that candlestick and then closes on a low. When that kind of thing happens, that is when you are very certain that, okay, that place can actually hold as your stop loss. That is where you want to place your stop loss per trade. But if you look at this here, we had a change of character, quite all right. Yes, there was a change of character, but there was no fractal high, which means liquidity hasn't been grabbed on this particular region. So what happens? You end up being the liquidity like this, and then you get grabbed, your stop loss gets hit. So next time when you're trying to trade, you know, using smart money concepts, supply and demand, yes, even though price reacts to your point of interest, you have a change of character, quite all right, signifying a downward trend. Look behind the change of character and ensure you are seeing a fractal high, which means a liquidity sweep, which means there was a huge candlestick that broke into your point of interest and then automatically wicked out at the candle close. It wicked out respecting that region. Then you can place your stop loss at that point. When you place your stop loss at that point, entry at the last buy before the sell, target you at least 1 to 2 risk to reward ratio, and you will have much more chances of hitting your TP and less chances of hitting your stop loss. So that is just the tip I wanted to tell you. Next time you are trading, always make sure there is a fractal high behind your change of character. Trades like this, when you do not see any fractal high, just avoid it. Avoid it, all right? Because this trade would have ended up hitting your stop loss and you'll be like, what happened? So next time, just make sure you have a fractal high. If you do not see any fractal high, the same thing when you're trading demand, you look down. If you want to see a fractal low behind your change of character in line with your point of interest, and then that is a valid place to place your stop loss and you will hit your full TP. So that's it on today's video, and I'll see you guys in the next one. If you actually enjoyed any value from this video, do me a favor by hitting that like button, the subscribe button, and it also encourages me to do more videos like this. And I'll see you guys in the next video. Cheers.